And you are just in time for your most comprehensive weekly look at the world of business and economics. Welcome, this is Business Redefined, and I am Julian Amboko, and this is the Budget Week. On Thursday this week, just the day after tomorrow, Treasury Cabinet Secretary Ukur Yatani will be tabling his maiden national budget before the National Assembly. The budget for the financial year 2020-2021 comes against the backdrop of extraordinary circumstances, with revenue prospects battered by the COVID-19 pandemic, even as expenditure is expected to stand at 3.22 trillion shillings. But even before the budget is tabled, the estimates have evoked mixed reactions from the public. Is the projection of 1.6 trillion shillings in ordinary revenue realistic? Can Kenya renegotiate its way out of the 900 billion shillings debt servicing obligations in the coming financial year? How will the proposed tax measures, which are of course included in the finance bill, impact ordinary citizens' day-to-day lives? To unpack this and a lot more, I am joined by Edna Gitachu, the tax policy lead at PwC Kenya, as well as Robert Wareru, who is the Associate Director for Tax and Regulatory Services at KPMG. Welcome on set. And I want to start with Edna. This is a very unique budget in the sense that this is the first time we are having the finance bill coming at the same time as we are discussing the budget. How has this change in the sequencing of the budget cycle impacted the whole process, Edna?
And a very good evening to all our viewers. So Amboko, this is a very welcome move when it comes to the budget making process, and there are very many benefits from a taxpayer perspective and also from a government perspective. But before we get into the benefits, just allow me to step back a bit and give context as to how come we are at this point. So previously what used to happen is that the CS National Treasury, after reading his budget speech, would be required to table the finance bill before the National Assembly. And thereafter, it would take 90 days to enact this finance bill into law. So during the intervening period, from the first time that the finance bill would actually be tabled in the National Assembly to the 90 days, the end of the 90 days, National Treasury and KRA relied on provisional collection orders. So what this meant is that during this intervening period, National Treasury was still able to collect revenue as if the proposals had been passed into law. 2 years ago, this was challenged in the courts, and the courts declared this as unconstitutional. So to be able to align our budget making process with the Constitution, the Public Finance Management Act was amended last year, and going forward, we expect that the finance bill will be tabled before the National Assembly by 30th of April every year and will be enacted into law by 30th of June every year. But to your questions around the benefits that we see, from a taxpayer's perspective, it's no longer a secret what changes the government intends to bring on board. So taxpayers are able to plan accordingly, and if they require to reconfigure their accounting systems, they have at least 2 months to be able to do that. From a government perspective, there's certainty in terms of collection of taxes, because then they can be able to budget for a full year of collection of taxes, as opposed to what used to happen previously, where you'd have some proposals would be dropped midway, and government did not have the ability to continue collection of taxes using these measures contained in the finance bill throughout the fiscal year. Thanks, Julian.
Some good thoughts there, Edna. And coming to Robert, the Treasury expects to collect up to 1.6 trillion shillings in ordinary revenue. Now, these are very extraordinary circumstances, and many of us feel that this is a bit of an ambitious target being set. What are your thoughts, Robert?
Thank you very much, Julian. Definitely an ambitious target, you're right, in the sense that in the coming year that we're just coming to an end, revenue expects to collect just under 1.4 trillion. And you recall that that number has been coming down from 1.8 trillion. Now, when you tell us that you're going to collect 1.6 trillion in the coming year, that is definitely an ambitious target. Remember that we are coming from a period where tax rates have been cut, corporation tax rates have been cut, PAYE rates have gone down, VAT has also gone down. And in fact, the Budget and Appropriations Committee estimates that these changes will cost the government about 170 or so billion shillings. So it's definitely a very, very ambitious target, and it's one we are waiting to see how it pans out. Julian?
Edna, what are your quick thoughts in terms of the targets being set by the National Treasury? We understand the Budget and Appropriations Committee is saying at best we'll just manage 1.5 trillion shillings.
And I think that speaks to the general mood of the country, and this is not unique to Kenya, really. If you look at other countries across the world, they are having challenges meeting these targets. Why? Because of the slowing economy. If you look at consumption, for example, people are not consuming as much as they previously used to. If you talk about restaurants, if you talk about tourism, if you look at other sources of revenue, for example, employment income tax, which what we call PAYE, this is also a challenge. If you think about the job losses, for example, again in the tourism sector, this is definitely a very challenging and ambitious target. And I think it's really high time that we thought about relooking at these targets and coming up with realistic revenue targets, which will then inform a realistic expenditure budget. Definitely ambitious.
Moving gears to Edna, the Treasury has proposed a number of ways through which it says it will be meeting some of the revenue gaps it is facing. There is a proposal to tax the digital economy, and the Treasury published the regulations not too far back. What are your thoughts on this, Edna?
So when it comes to the taxation of the digital economy, this is not a problem that is unique to Kenya. It's actually a global concern. And what has been happening is that previously we'll have businesses setting up where their customers are located. So we'll have non-resident businesses setting up, say, here in Kenya to be able to serve their customers. But with the advancement of technology, we no longer require physical presence. So we can still be able to get the goods and services through a technological platform or through an online platform. So this obviously poses some tax challenges. And there are two challenges, one from an income tax perspective and another one from a VAT perspective. So in the finance bill, there is a proposal to introduce digital service tax, which is an income tax at the rate of 1.5% of the gross value of the transactions. And to your question, when it comes to the value added tax perspective, when you buy goods from a non-resident, these goods are going to be cleared through a port. And at the port of clearance, you'll be able to pay your taxes. But when it comes to services, then there is no clearance at any port. So there is a revenue leakage where that is concerned. Because if the same service was to be procured here in the country, then there would be VAT that would be attracted. But because this is being procured from a non-resident, then we do not have the incidence of VAT. So to level the playing field, the regulations are actually a very welcome move because both residents and non-residents, so long as they hit the VAT threshold, will be required to charge VAT. And maybe, Julian's one more thing around the VAT regulations is that from a business to business perspective, we do not have a challenge because already there's a mechanism of collection of this VAT. But when it comes to business to consumer transactions, there has been a gap there, and this is what the regulations are seeking to address. Thanks, Julian.
And just to stay with you on that subject of digital taxation, some have raised the concern that this taxation is coming at a time when we're trying to move digital, of course, because of COVID-19 concerns. Some think that this could now, should it be passed by Parliament, many will now revert to cash transactions. Is this a valid concern?
Well, Julius, I don't think so. I think the ship already sailed and digital economy is here to stay. Probably we are going to experience restricted growth at the initial stages as we try to implement these taxes. But going forward, we expect a lot of transactions around the digital platforms.
Robert, just to hop onto your quick thoughts before we take a quick break in terms of the digital services transactions.
I agree with that. Now, this is here to stay. And if you look at the volume of M-Pesa transactions in this country, that should give you an idea that this is where tax law is headed. And clearly, the taxman has not been left behind. He sees that this is going to be a fertile ground for shoring up this badly needed tax revenue, Julians.
Right, and that point by Robert Orero takes us to our first break. We are exploring Budget 2020-2021, dealing on a number of issues, including some of the tax measures being proposed. We'll be right back in a few minutes. Welcome back to Business Redefined. If you're just joining us, we are focusing on matters budget 2020-2021. And of course, I am joined by Robert Orero, Associate Tax Director at KPMG Kenya, and Edna Gitachu is the Tax Policy Lead at PwC Kenya. And you can be part of this conversation online at NTV Kenya at AmbokoJH. The hashtag is Business Redefined. Edna, I want to bring the subject of debt, which of course is a matter of grave interest. If you look at the budget numbers, in the coming financial year, we'll be paying up to 900 billion shillings in debt servicing obligations. What do you think about this and what can be done in this situation?
Yes, so Amboko, three measures come to mind. The first one is from a revenue perspective. Is there opportunity for government to actually sell off some of the stakes that they have in private companies or in the companies that they own, commonly referred to as privatization? And this way we'll be able to release some funds to be able to fund our expenditure or even prepay off our loans. From an expenditure perspective, looking at the development expenditure, probably we can start thinking about accelerating public-private partnership programs so that we do not suffer from a development perspective. When it comes to recurrent expenditure, we can see where we can be able to make some cuts on our expenditure. An example would be around training. We don't earn overseas travel. We probably do not have to go overseas, or government doesn't have to travel overseas. We can still have these conferences here in the country using virtual technology. And the third option that I would see is around debt. And one of the questions is it time for us to restructure our debts? Is it time for us to be able to do a cost-benefit analysis and see what is the cost of retirement of this costly debt vis-a-vis the cost of the concessional loans that we are going to take on? So I think going forward, maybe we should focus more around the concessional loans, Amboko.
Robert, Edna has some very interesting proposals here. One is divestiture of government stake in some entities, which I imagine Parliament this afternoon, as well as restructuring. And the CS Treasury has been very categorical that one of the concerns government has is the impact this will have on Kenya's credit ratings. Now, we know Moodys downgraded Kenya. What are your thoughts on this?
Yeah, I do agree with Edna there. The only question that I have there is, if we were to divest today, is this the right market condition for us to divest as a country? And that might, result in a delay in cashing in some of these assets. However, to your point around renegotiation, I think there's nothing wrong with Kenya renegotiating with individual lenders, because one of the things that you want to avoid is being seen to be struggling or sort of defaulting on your loans, and therefore calling in other loans. So one of the things that Kenya has to, I think, should do, and I think it's actually doing, is individually talking to these debtors or creditors so that they can reschedule for us our loans. And then the third point, which is what Edna alluded to, is I think we need to look at concessional financing, concessional loans, which come in at a much lower interest rate, and then longer term debt. If you look, I'll give you a very good example, a quick one. Egypt, 3 weeks ago, in this economy, in this kind of tough COVID economy, Egypt raised a bond of $5 billion, and guess what? It was subscribed 4.4 times. They had bids totaling $22 billion in this market. So what we're saying is that we think there's an opportunity for this country to go back to the international market, get longer-term debt, which is better priced, and not crowd out the local businesses. Julius?
Edna, when you hear what Robert is proposing here, and you look at the numbers being put out by Treasury, of course, borrowing up to 300 billion shillings in the coming financial year, do you feel that there'll be appetite in the international market for this kind of debt from Kenya? And what kind of premium will we be paying, for example, considering the kind of environment we are in presently?
Well, this is actually a very difficult time for government to go and borrow commercially. And therefore, maybe to my earlier point, that's why I think it would be easier for government to be able to take concessional loans. And these concessional loans could be from the Bretton Woods institutions or government-to-government institutions, government-to-government loans, because currently it might be very expensive to tap into the commercial market. Julian's.
Robert, switching gears to something else here, Treasury has been very categorical that the agenda for the next budget is to seal revenue leakages, and they are slashing the number of tax exemptions they've been extending. What are your thoughts among some of the proposals which have been made, especially in terms of doing away with tax exemptions?
That's a very good question, Julian. I think it's a noble idea. However, we've got to be very careful about what specific exemptions we are doing away with. And I'll give you an example which is close to my heart. If you look at last year's census report, Kenya's electrification rate is at about 74%. Now, this 74% is divided about 49% main grid and about 24% solar. Now, when you propose to impose VAT on solar products, that becomes a challenge, because if you think about it, about 40% of the frontier counties are lit by solar. So you cannot afford to impose VAT on solar products. Otherwise, you're just basically saying those guys will never have electricity. They'll not have, the dispensaries and clinics will not have solar equipment to keep their vaccines cool. So I think, yes, it's a good initiative. However, we've got to be very careful about specific ones. And I hope that members of parliament will vote to retain some of these exemptions like that one on solar equipment. Julians.
Still on this subject, Edna, if you look at going back now to the tax laws amendment bill, the manufacturing sector took a significant hit, especially in terms of the capital allowances that were taken back by the government. How do you feel Budget 2020-21 leaves the manufacturing sector, especially because it's normally the large absorber of the labor market and creation of employment?
Yeah, so Amboko, this was a surprise when the Tax Laws Amendment Act was passed, because there has been efforts by government to ensure that Kenya is more of a manufacturing country and exporting the locally manufactured products. But having said that, with the reduction of the exemptions and the incentives given to the manufacturers, this is not the only thing that comes into play when an investor is making a decision as to whether or not to invest in the country. For instance, a manufacturer would be concerned around the cost of power. Is it affordable? How does it compare to other countries within the region? When it comes to infrastructure, do they have access to their market? Do they have access to their raw materials? So I think over and above the tax incentives, there are also other issues that the manufacturers are concerned about. And most importantly, about their export market. Who are they exporting to? Do they have special regimes such as the special economic zones that they would be able to play under? So I think these are some of the concerns. And looking at the national industrialization policy, it is broader than just the tax incentives. And the word of caution maybe to the lawmakers is that when these laws are being amended, they should be looked at wholesome and not just singling out the tax incentives in isolation. Julians.
Great. I'm told we have about a minute to go, and just to get to the tail end of our conversation. To start with you, Robert, the bigger concern around Kenya's budget framework is a tax policy, and we've been discussing this issue quite a bit of time. What do you think should be considered when this is being formulated?
A tax policy, I think the thing, Julian's here is that as a country, we need consistency, because business people are looking for a longer-term, consistent environment within which to operate. People don't mind paying taxes, but can we have a consistent environment? And really what we are asking here is for policymakers and National Treasury really to inform the public of this policy so that we can engage on that. Julians?
Edna, your thoughts on the tax policy framework?
Yes, so Julians, I think the first concern that I would have is what is the connection between the tax policy and the economic blueprint of this country, Vision 2030 or the Big Four agenda? Because there is a bit of disharmony here. Looking at the Tax Laws Amendment Act and also the Finance Bill, some gains around these two, especially the Big Four agenda, are going to be taken away through the changes in the Finance Bill. So we need to be consistent as a country, looking at the tax policy against the economic blueprint of this country. Julians.
Right, and unfortunately, that's where we have to leave it with Robert Warero and Edna Gitachu focusing on matters regarding the budget 2020-2021. It has been a discussion which will be carrying on, especially going tomorrow and Thursday on the budget day. NTV will definitely be unpacking all the details regarding the budget and all the details which will be impacting you in terms of taxation. So stay tuned to NTV for this and more. Up next is the Markets Report.
Markets Review, proudly brought to you by Business Daily. More possibilities.
And to take a look at some of the issues that have been shaping the stock exchange this week, the NSE 20 share index closed today at 1982 points. Year to date is down 25%. But compared to the last trading session, which was yesterday, it's up marginally by 0.7%. So, of course, we'll be looking to see how the market responds to the budget proposals being tabled on Thursday. But to look at the Forex market very quickly, how the shilling closed against the dollar. Of course, it closed at 106.29, gaining marginally by 0.14%. Against the sterling pound at 134.69, down marginally by 0.11%. And against the euro, it didn't change compared to yesterday, closing at 120.09 points. Of course, it's been a very quiet period for the Forex market. And that takes us to the close of business as far as Business Redefined is concerned. Remember, we'll be having a wall-to-wall coverage of the budget 2020-21, looking at all the tax proposal measures and how this is likely to impact the business environment as well as households. I've been your host, Julian Samboko. Stay tuned for more on NTV in the programming.